Somewhere in America, right now, a woman is applying for a mortgage. Her credit is good, her job is stable, she's never missed a payment in her life. And then the loan officer pulls her file, and there it is. A collections account she's never heard of, a debt she never agreed to, a number that's been sitting on her credit report, quietly wrecking her score for months. She didn't spend that money, she didn't sign for it. In a lot of cases, she doesn't even owe it. Millions of Americans are living this exact moment without knowing it yet. Debt that was never explained to them. Sold, resold, and reported while they had no idea it existed. So here's the question this video is going to answer. If you never got the bill, who decided you owed the money? Before I show you how this actually works, take a guess. Who do you think profits the most from debt you don't even know you have? The hospital, the bank, or a company you've never heard of? Comment your answer, because I promise you, it's not who most people expect. Most people think debt works like this. You borrow money, you get a bill, you pay it, or you don't. That's not actually how a huge slice of American debt works anymore. A large and fast-growing category of debt in this country changes hands before the person who owes it ever finds out how much it costs, or sometimes that it exists at all. The clearest example is medical debt. According to the Consumer Financial Protection Bureau, tens of billions of dollars in unpaid medical bills sit in collections on Americans' credit reports at any given time. And medical debt has been, for years, the single most common reason ordinary Americans get contacted by a debt collector. More than credit cards, more than car loans, more than anything else. But here's the part almost nobody talks about. A hospital bill doesn't have to stay with the hospital. It can be sold, bundled with thousands of other unpaid bills, sold in bulk, for pennies on the dollar, to companies whose entire business is buying debt cheap and collecting it in full. That sale can happen without a phone call, without a letter that actually reaches you, without you knowing your $500 ER bill from 18 months ago just changed hands. And once it lands on your credit report, it doesn't matter that you never got a bill. The system doesn't ask, did they know? It just asks, did they pay? So the real question isn't just who's in debt. It's who decided you were, and when were you ever going to find out? And here's a prediction question worth pausing on. Before this account ever reaches a debt buyer, do you think the hospital tries harder to reach the patient? Or does the debt buyer try harder once they own it? Sit with that for a second, because the answer says a lot about where the incentives in this system actually point. Let's follow the money, because this is where it gets uncomfortable. Say you go to the emergency room. You're insured. You assume insurance handles it. But healthcare billing in America runs through multiple companies before a final number ever reaches you: the hospital, the physician group that isn't technically part of the hospital, the ambulance company, the lab that read your blood work. Each one bills separately. Each one can end up sending its bill to a different address, at a different time, sometimes months apart. One study found that 2/3 of people with medical debt say it came from a single, one-time medical event, not years of chronic illness, not reckless spending. One bad night, split into 5 invoices from 5 different companies, arriving on 5 different timelines. Now imagine you moved, or the bill went to an old address, or it went to your insurance first, got denied for a coding error, and came back to you 6 months later, after you'd already forgotten the visit happened. That bill doesn't just disappear because you didn't see it. After a certain number of days, unpaid medical bills are typically sent to collections. And collections agencies don't need you to have opened the mail. They need the account, the amount, and a legal basis to try to collect it. By the Federal Reserve and CFPB's own accounting, roughly 1 in 5 Americans has, at some point, had medical debt appear in collections on their credit file. Peterson KFF's research puts the number of adults currently carrying some form of medical debt at around 20 million, and that's before counting the debt people carry on credit cards, through payment plans with hospitals, or money borrowed quietly from family just to cover a bill. Here's the number that should stop you. 1 in 10 Americans with medical debt say they borrowed it from a friend or relative. That debt doesn't show up on any government report. It's not in any of these statistics. It just sits there, inside a family, invisible to every system except the 2 people who know about it. Think about how disorienting that actually is in practice. A family budgets carefully around one number, the hospital's estimate, or the amount insurance said they'd owe, and then, months later, an entirely different number shows up from an entity they've never dealt with before, using an amount that may have grown with interest and fees along the way. There's no single moment where someone sits the patient down and says, here's exactly what happened to your bill, and here's what you owe now. There's just a letter, or a phone call, or a line on a credit report that appeared without warning, and it isn't spread evenly. Research consistently shows that uninsured Americans, lower-income households, and Black and Hispanic families carry medical debt at higher rates than the general population. Even people with insurance aren't safe. About 1 in 5 insured Americans report struggling to pay medical bills, and the ones getting hit hardest are often the people with high deductible plans, the kind that look affordable on a paycheck but leave you exposed the moment something actually goes wrong. So who's winning here? Not the patient. The patient is the one finding out months later that a decision was made about their finances without them in the room. Now here's where the story stops being about hospitals and starts being about an entire industry most Americans have never heard of: debt buying. When a hospital, credit card company, or lender decides an unpaid account isn't worth chasing anymore, they don't just write it off and forget it. They sell it often in massive bundles of thousands of accounts at once to companies called debt buyers. These companies pay a fraction of the original amount, sometimes just a few cents for every dollar owed. Then it's the debt buyer's job to collect the full amount. Every dollar above what they paid is profit. This is a real regulated industry, and much of it operates within the law. But the incentive built into it is worth sitting with for a second. The debt buyer makes more money the more debts they can collect on, at the lowest possible cost per account. That doesn't exactly reward slowing down to make sure every notice reaches the right person at the right address. Take a second and think about which one of those two you'd bet on. Most people guess the hospital fights harder to get paid directly. The numbers suggest the opposite. Debt buyers are built for exactly this kind of chasing, at volume, because it's the core of their business rather than a side task for a billing department that's already moved on to the next patient. And debt doesn't always stop with one sale. It can be resold again and again. Each time it changes hands, the paper trail gets thinner, and the odds that you, the person the debt is attached to, actually get a clear, timely notice gets smaller. This is where the phrase zombie debt comes from in the industry: debt that's old, sometimes past the legal window where you're required to pay it, sometimes tied to identity mix-ups or billing errors that keeps getting bought, sold, and chased anyway. The Consumer Financial Protection Bureau has taken enforcement action against collectors for exactly this, pursuing people for medical debts those people had already formally disputed. Not debts that were confirmed accurate, debts that were disputed and pursued anyway. And it's not just old debt buyers pulling this. Some patients say they've been billed for care that should have been covered under the No Surprises Act, a federal law that took effect in 2022, specifically to stop patients from being blindsided by out-of-network emergency bills. The law exists because before it, someone could go to an in-network hospital, be treated by an out-of-network doctor they never chose and never met, and end up with a bill they had no way to predict or prevent. Here's the twist most people don't see coming: this isn't fringe. It's not a scam operating in the shadows. It is a normal, legal, well-established part of how American consumer finance works. The mechanism isn't hidden because it's illegal. It's hidden because almost nobody explains it to you before you're the one it happens to. Zoom out, and you start to see how much of the American financial system runs on exactly this kind of asymmetry: one side with full information, moving fast, and the other side finding out only when it's already too late to do much about it. Medical debt just happens to be the clearest example, because almost everyone eventually needs medical care, and almost nobody negotiates the price of it in advance the way they would a car or a house. So who benefits? Not primarily the hospital. They already got a fraction of what they were owed and moved on. Not really the original lender. The biggest winners are the companies built specifically to buy debt cheap and extract it in full, at scale, from people who often don't even know the account exists until it shows up somewhere that matters: a credit check, a loan application, a background check for an apartment. But here's the part that changes the entire story. For years, this system operated with almost no real check on accuracy. Then, starting in 2022, the three major credit bureaus, Equifax, Experian, and TransUnion, made a set of changes that quietly reshaped the landscape. Paid medical collections were wiped from credit reports entirely. Small medical debts, under $500, were excluded, and Americans got a full year, instead of a matter of months, before an unpaid medical bill could even appear on their credit file. It's worth remembering how new some of this protection actually is. For decades before these reforms, a $500 dispute with an insurance company over a routine test could sit on someone's credit file for years, quietly limiting what they could borrow, rent, or buy, regardless of whether the charge was ever actually correct. The result, according to the Urban Institute's research, was dramatic. The number of Americans with medical debt and collections on their credit reports was cut roughly in half. Cut in half. That's not a small policy tweak, that's tens of millions of people whose financial reputation had been quietly damaged by bills, some accurate, some not, that the old system gave almost no room to question. But, and this is the part that matters, cutting the number in half still leaves the other half. As of the most recent data, roughly 15 million Americans still have medical debt sitting in collections on their credit report right now. And separately, when you count every form of health-related debt, hospital payment plans, medical credit cards, money borrowed from family, debt that never touches a credit bureau at all, investigations by KFF Health News and NPR put the number of Americans carrying some kind of healthcare debt above 100 million. So which number is the real one? The 15 million whose debt is visible, tracked, and reportable, or the far larger group carrying debt the system doesn't even measure? Even that isn't the whole picture, because a lot of this debt never looks like debt at all. Some hospitals push patients toward medical credit cards right at the point of care. Sign here. Spread the cost out, don't worry about it today. The CFPB has warned that these cards often come with deferred interest, meaning if the balance isn't paid off in full by a specific date, the patient can suddenly owe interest retroactively on the entire original amount, not just what's left. By the agency's own estimate, Americans have paid roughly $1 billion in this kind of deferred interest on medical debt in just a few years. It's not fraud. It's printed in the terms and conditions. But it's the same pattern again, a financial decision made in a moment of stress in a doctor's office that most people don't fully register until the bill arrives, looking nothing like what they expected. It's the same asymmetry playing out again, dressed up as a convenience. The paperwork gets signed in a moment when the patient's attention is on their health, not the fine print, and the terms rarely get revisited until the bill arrives looking very different from what was expected at the counter. Here's why this isn't just a statistic, it's a wall that shows up in the middle of someone's life. A collections account on your credit report can lower your score by dozens of points. That can be the difference between qualifying for a mortgage and getting denied, between a fair interest rate on a car loan and a punishing one. In many states, landlords run credit checks before approving an apartment application, meaning a bill you never saw can quietly cost you a place to live. And the CFPB's own research has documented a brutal irony. The fear of debt collection changes behavior even in people who are trying to do everything right. Nearly 4 in 10 U.S. adults report they've skipped, delayed, or gone without medical care in the past year, specifically because of cost concerns. Not because they didn't need it, because they were afraid of what it would cost and increasingly of what happens after the bill, when it's out of their hands entirely. That's the doom loop underneath this whole story. People avoid care to avoid debt. Avoiding care lets small problems become expensive ones. Expensive problems generate bigger bills. Bigger bills are more likely to end up unpaid, sold, and chased by someone whose job is to collect, not to explain. Multiply that by tens of millions of households, and you start to understand why medical debt shows up again and again in surveys about why Americans can't save, can't qualify for credit, or feel like they're falling behind no matter how carefully they manage their paycheck. It rarely announces itself as a crisis. It just quietly narrows what's possible, one denied application at a time. Meanwhile, the people actually running this system, the debt buyers, the collection agencies, are, for the most part, doing exactly what the law and the incentives allow. This isn't a story with an obvious villain twirling a mustache. It's a story about a system where nobody in the chain is specifically responsible for making sure you find out what you owe before it starts costing you. And the policy ground underneath all of this keeps shifting. Some states have passed their own medical debt laws in recent years, restricting how aggressively hospitals can pursue patients, or barring medical debt from credit reports entirely within their borders. Other states have seen similar bills stall against industry opposition. And that gap between states creates its own quiet unfairness. The exact same medical bill, the exact same missed notice, can end up mattering very differently for your credit, depending on which side of a state line you happen to live on. At the federal level, oversight has moved in different directions depending on who's in charge, with some proposed protections rolled back even as public pressure to fix the system keeps building. Some nonprofit hospitals, facing scrutiny over aggressive billing, have expanded financial assistance programs, forgiving bills entirely for lower-income patients who qualify, but only for the patients who know that assistance exists and know to ask for it before the account gets sold. Once it's out the door and in the hands of a debt buyer, that option is usually gone. So let's go back to the question from the start. If you never got the bill, who decided you owed the money? The honest answer, often, no single person decided anything. A hospital's billing software generated a claim. An insurer processed part of it and rejected part of it. 90, 120, 180 days passed. An algorithm flagged the account as delinquent. It got bundled with thousands of others and sold to a company that specializes in exactly this kind of account. That company's own system started the collection process. At almost no point in that chain did a human being confirm that you specifically understood what was happening to your name and your credit. That's the mechanism. Not a conspiracy, a pipeline, built legally over decades, optimized for moving debt efficiently from the people who no longer want to chase it to the people whose entire business model is chasing it. And remember the guess from the beginning of this video who profits the most? Not the hospital, not the bank. It's the debt-buying industry sitting in the middle, an industry most Americans could not name if you asked them, built entirely around the gap between when a bill is generated and when the person it belongs to actually finds out. So what do you actually do with this? Check your credit report. All three bureaus are required to let you see it for free at annualcreditreport.com. Most Americans check it rarely, if ever, which means most Americans have no idea whether a debt like this is already sitting there, waiting to surprise them at the worst possible moment, like during a mortgage application. Ask yourself honestly, when was the last time you actually looked? For most people watching this, the answer is months ago, or never. That single gap is exactly where this entire system operates. If you find an account you don't recognize, you have the legal right to dispute it. Debt collectors are required to verify a debt before continuing to collect on it if you formally challenge it. That single step, disputing an account you don't recognize, has stopped collections dead in cases where the CFPB later found the debt was already resolved, disputed, or simply wrong. It's also worth knowing that if a bill comes from a hospital, many have financial assistance policies that most patients never ask about, simply because nobody tells them it exists until after the account has already been handed off. The system that created this problem didn't design itself to be malicious. It designed itself to be efficient, and efficiency, when nobody's specifically responsible for whether you understood what was happening, quietly becomes something that looks a lot like being kept in the dark. Here's the uncomfortable truth this story leaves you with. In America today, you can be in debt, have your credit damaged, and lose out on a home, a car, or an apartment without ever having done anything wrong, and sometimes without ever having known. The bill doesn't need you to open it to change your life. The only real defense left is to go looking before it finds you first. If this changed how you think about the debt sitting on your own credit report, that's exactly why this channel exists, to pull apart the parts of the financial system nobody explains to you until it's already cost you something. Subscribe if you want more of these stories, because this isn't the only system in America built on people finding out too late. And before you go, drop your original guess in the comments where you write about who profits the most, or did this one surprise you too?